do you still believe that 250 is realistic by the end of the year?
And absolutely. I mean, look at what happened in 2021. We went from about 6,000 to 69,000 in 3 months, right? So, no, sorry. What was it in the summer? Whatever. I think we went up like 5 or 10x in a very short period of time in 2021 when that COVID stimulus really just like kicked in and went, turbo on the markets. So imagine that Trump and the Republicans have an election to win in 2026. And so they need to start making things look really, really good for the economy coming into the year end. And so I think that they're trying to front load the pain now, maximum pain now, so the voters don't really remember how much things sucked in April, May, June.
The crypto market is gearing up for what could be its wildest ride yet, and it all comes down to politics and liquidity. Remember 2021, when Bitcoin went from 5,000 to 69,000 in just a few months, thanks to COVID stimulus? Well, we might be setting up for a repeat, only this time with an election twist. Arthur Hayes points out that politicians have every reason to juice the economy later this year, especially with the 2026 midterms on the horizon. That means short-term pain now, market dips, could be followed by a flood of money printing and deregulation just in time for election season. And when that happens, crypto tends to go nuts. Sure, $250,000 sounds crazy, but so did $69,000 back in the day. With central banks likely to follow suit and pump liquidity into the system, Bitcoin could easily catch fire again. The key? Look past the current volatility and focus on the bigger picture. When the money faucets turn back on, things could move fast, and you'll want to be ready. Let's watch clips from Arthur Hayes' explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Are we in a bull market or are we in a bear market?
Bull market, easy. The bear market, depth of the bear market was November 2022, $15,000 Bitcoin after the FTX debacle, and we've rallied quite handsomely since then.
What makes you so confident that this market's still in an uptrend?
So, we went through the previous all-time high of 20,000 and the depths of the FTX crash and sort of the Fed hiking rates and other central banks at a very quick pace in 2022. And we took out 70,000, and then we went up to 110,000, and now we've still held above the previous all-time high. So I would say that we're in a bull market. Obviously, I'm talking about Bitcoin. Your shitcoin portfolio might have different results. If you had the leaders of the largest economic blocs like the United States, China, Japan, EU, telling their populace they would want to run an austerity program like what Milei is running in Argentina, then I would say that we're on the cusp of a bear market, because that means that they are willing to extinguish credit and rebalance the economy smaller so that it could grow from a healthy base. But instead, what we're hearing is we want to continue to run deficits. We have some ideas how to take around the edges in terms of imbalances in the global economy. This is what Trump and his tariffs and all that kind of stuff is about. But at the end of the day, even Trump, who people are saying is wrecking the markets and whatever, his plan is to go from a 7% deficit to a 3% deficit in 4 years. His plan is not to go from a deficit to a surplus and retire treasury debt. That's not his plan. So I don't know why people think that credit is not going to continue to flow. It will continue to flow. It's the only path forward, given the policies that the major economic blocs are pursuing.
His mandate, allegedly, is keep inflation down and keep employment up. That's pretty much what Powell's mandate is. You're saying that there's going to be a break away from the mandate here, and that they're going to step in to help the government?
Yes, and I think Powell is going to act just like every other Fed governor has acted in the past. For World War II, the Fed was subsumed into the Treasury, and they conducted yield curve control, where they fixed the price of bonds to allow the U.S. government to fund the build-out of the war. In the 1970s, Arthur Burns wrote a famous essay, which I quoted in the essay, The Anguish of Central Banking, where he talked about how the social programs that the US government was pursuing were incompatible with squelching inflation. And as the Fed chairperson, he felt that his duty was to the federal government to do what the politicians wanted. And he did that. Paul Volcker, yes, he did raise interest rates very aggressively in the early 1980s, but even he stopped short of going, full nuclear on things when Reagan and lots of senators and Congress people were on his ass in the early 1980s because of the steep recession. And we had the Greenspan put in the 1980s and 1990s, and then we had Ben Bernanke with helicopter money, and then we had Janet Yellen with her policies of continuing QE and then doing stealth QE at the Treasury Department, and now we have Jerome Powell ending QT essentially, while unemployment's at what, 4%.
Yeah.
The stock market's at all-time highs. Maybe it's off, 5 to 10%, but it's still all-time highs. And the U.S. economy has been growing above trend pretty much for the last, few years after COVID. So there is no need for easy monetary policy, other than the fact that the government has this exploding debt problem and they need to fund it, and therefore the Fed will do its duty and fund the government.
How you're saying this plays out is tariffs go into effect. China doesn't sell as much as they usually sell into the US, and I use China as a proxy for all other nations that don't have as many US dollars. They don't invest as much into treasury bills, but the Fed step in and the Fed become the buyer of the treasury bills. So very similar situation to what's happening in Japan, right?
Exactly. But it'll be a bit different. It might be, some tweaks around the edges with quantitative tightening. Maybe they're reducing mortgage-backed securities and then buying U.S. treasuries, or they're doing some things in the banking system with the supplemental leverage ratio exemption. Or there's a recent article published in Bloomberg about some economists saying that the Fed should backstop relative value hedge funds who are engaged in a treasury futures contract basis trade when they run into trouble if market volatility picks up, and the Fed should basically take over that position and run this trade for them instead. So again, there's various ways to do it, and they're going to try to say it's not quantitative easing because that's a bad word these days. It's not inflationary, but at the end of the day, the amount of dollars will increase to buy treasury bonds, and that will flow in its way into crypto. And I believe Bitcoin and the crypto ecosystem will do very, very well in fiat terms.
Forget bear market fears. Bitcoin's rally from 15.5K post FTX to 70K plus confirms this bull run is real. While altcoins flounder, Bitcoin keeps smashing records, and the key driver is relentless liquidity. No major economy is cutting deficits, not the US, EU, or China. The Fed may pretend to fight inflation, but history shows they'll print to fund deficits. With yield curve control looming, fresh money will flood into crypto. The US 10-year Treasury bond is taking a sharp dive, with recession fears pushing investors towards safe havens. Meanwhile, Bitcoin's been volatile this April, still tied to tech stocks like the Nasdaq, but it could soon start acting more like gold. With global uncertainties, tax season, and the looming debt ceiling, the market's looking choppy. But here's the shocker. If you're feeling risk-tolerant, dollar cost averaging into Bitcoin now could set you up for big gains once central banks step in. Let's watch more clips from the interview.
Talk me through the 10-year treasury bond coming down so sharply. Why is the 10-year responding like this?
Because people think, oh shit, the markets are falling. There's going to be a major recession. Therefore, the reaction is I need to go into bonds. I need to go into the safe haven. I need to go into 10-year treasuries, and that's why they're buying them. April is going to be a tough month. We have this tariff digestion. The market still believes that Bitcoin is a one-to-one proxy for the Nasdaq, and people are starting to sour on U.S. big tech. So that's coming off, and so people are like, oh, okay, well, Nasdaq goes down, therefore Bitcoin goes down. I think Bitcoin is going to perform more like gold, but it's going to take a while for the market to sort of ditch this correlation between the Nasdaq and Bitcoin. You have taxes being paid by persons in the United States coming up on April 15th. That's a liquidity negative event because people have to sell things to pay their taxes. You have the debt ceiling in the US. It's unclear whether or not the Treasury is going to refill their checking account. So they've been drawing it down. It was about $750 billion at the start of the year. Now it's about 360 odd billion. And as the government cannot issue debt on a net basis right now, the Treasury needs to draw down this account so that it can, fund the various agencies. But once that debt ceiling is resolved, and it will be resolved, then the question is, does the Treasury say, okay, I need to issue a bunch more bonds, suck liquidity out of the system, and raise my balance back up to, say, 700 or 800 billion? We don't know. We'll find out in early May when the quarterly refunding announcement comes out from the Treasury about what their target is for their cash balances. So I think, April's going to be a lot of uncertainty. There's max tariff hysteria, people freaking out. There's going to be this global recession, change in the monetary order, all those sorts of things. So I think it's going to be very choppy, a choppy to down month. Obviously, I hope the 76,500 holds. I think it will, but I think we're going to come close to testing that.
When do you think the markets digest all of this and actually start turning upwards? If you say April's going to be a volatile month,
I think we'll have to see what Powell says in the May meeting of the Fed, and also, China and EU have claimed that they're going to do retaliatory tariffs or do other things to counter this effect, right? So what's the easiest way to counter tariffs? Allow your currency to depreciate, right? So China is creating lots of credit internally. Fiscal expansion is about 10% of the budget right now. However, for whatever reason, Xi Jinping does not want the yuan to depreciate drastically against the dollar, and therefore the PBOC has been actively raising interest rates to defend the currency, defend the 7.3 level that is their line in the sand at the current moment. So the question is, okay, now Trump came out with, I don't know what the tariff is on China, like 30 or 40%, whatever it is. Does he say, let's just torch the yuan, and if the yuan goes down by 20-30%, then I've sort of just negated all this tariff impact, and people continue to buy Chinese goods in the same quantity because the effective price is the same. But all that credit is out gushing forward out of China because the PBOC is no longer sterilizing it with raising interbank rates. So again, it's going to depend on what other people do. What does the ECB do? Are they going to start buying bonds or continuing to cut rates? What's going on in Japan? It's pretty much a bloodbath today in the Japanese markets. The banks got crushed. There's a question of whether the BOJ is going to hold or even continue to ease when they said they're supposed to be raising rates at their next meeting. So again, it's not just the Fed. Everyone else is now going to react to what Trump has proposed in their own best interest. I obviously think in the medium term that means printed money, but we're going to have to see what these central bank and finance ministries say about what they're going to do from a monetary perspective to counter the effects of tariffs on their countries. If you're extremely risk-seeking, then I think you're deploying capital in a small way, right? You're dollar cost averaging or just doing a TWAP, time-weighted average price, not trying to pick a level, but saying, okay, I know that there's a lot of stress right now. I think in the medium term, the money is going to be printed. And whether it's I buy it 78,000 or 85 or 89 or whatever, in 6 months' time, I'm going to be glad that I bought during this period. Or you could say, I'm going to wait for a definitive statement from one or more central banks saying, I'm going to provide, easy money to counter this change in the global monetary order. Now, obviously, once that happens, the market's going to be much higher. However, you're going to be very confident that you've escaped sort of the bear trap, and there's not going to be, a crash below 76,500 or some other level in whatever coin or token that you're trading.
The crypto market's current stagnation is a coiled spring, not a stalling engine. Bitcoin's 2-month consolidation below its all-time high mirrors historical patterns that preceded parabolic moves. Analyst eGrag Crypto's 231-day cycle analysis suggests a June breakout targeting $175,000 by September. This technical setup converges perfectly with the macro liquidity tsunami brewing behind the scenes. We've seen this movie before. When governments choose between austerity and money printing, the printing presses always win. The 1970s showed us Arthur Burns' Fed surrendering to political pressure while modern central bankers face even greater debt burdens. Market veteran Arthur Hayes puts it bluntly, yield curve control is coming. It's just QE wearing a different hat. This inevitable liquidity injection will send capital flooding into scarce assets, with Bitcoin positioned as the prime beneficiary. Bitcoin's recent 4% dip during tariff announcements versus stock's 10% plunge demonstrates its growing immunity to traditional market shocks. Add shrinking exchange reserves, indicating accumulation, the 69.5K support floor, and the technical scream accumulation phase. The coming months will reveal a simple truth. In a world of currency debasement, hard-capped digital gold doesn't just survive, it thrives. Whether $175,000 or beyond, this bull run's next leg will be fueled by the oldest market force of all: too much money chasing too few sound assets. The only question is whether investors will be positioned before the liquidity dam breaks. As we wrap up, do you believe this cycle will peak at $250,000, or are we underestimating Bitcoin's upside? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.